Yesterday we had the earnings that everyone was looking forward to. It was Apple after market close, and what an earnings it was on the face of it. And we can in fact see right now it is up over 6%. And in today's episode we're going to discuss why it is not all great news, a lot of factors to consider that you may have missed. We're going to do a deep dive into the company, looking at the income. We're going to look at their top line revenue growth year on year, as well as their bottom line net income. We're going to look at the health of the company, their total cash versus their total debt. And we're going to not look just at their dividend safety, but the underlying supporting metrics, the free cash flow, the ROIC. And we're going to look at both insiders as well as institutions to see if they have been buying or selling over the last few quarters. And we're going to do a deep dive into the earnings so you can understand not just the good, but also the bad and ugly that were in those earnings. And very importantly, we're going to dissect those numbers and really highlight where the key issues are for Apple moving forwards. As always, we are going to run it through the valuation model, getting to our intrinsic value as well as our acceptable buy price given our investor margin of safety, and we'll also look towards Wall Street to see what they target for the next 12 months. Now, in today's episode, we are going to look at 3 different growth rates moving forward, a low, medium, and high, so you can understand where we are getting these numbers from and the expectation over the next few years. So before we jump into their earnings, let's just get an updated look. So we can see we have 1 buy rating from Wall Street and 2 holds from Seeking Alpha and Quant Analyst. We note even with the pop today, it is in the midpoint of the 52-week range. It does have a forward yield of 0.55% and a forward PE now at around 26.4. It is higher than the S&P average of around 21.5. Now, even with the jump, it is still down -4% year to date. However, if you have been a shareholder over the last year, you would be up over 10%, and a shareholder over the last 10 years up around 784%. Bear in mind, if you do reinvest those dividends, it would be slightly higher. Now, in terms of the actual earnings, let's have a very quick high look. And the biggest announcement was their largest ever share buyback of 110 billion. And as you can see in the same sentence, it also notes that iPhone sales are down around 10%. So something just to think about, a few reasons that I do want to mention. The first one is we see iPhone sales down double digits. Now, that is a very big worry, but what they have kind of done here is smoothed it over with their largest ever share buyback program, which we will give our thoughts shortly. Now, in terms of how they've performed, and typically Wall Street do look at more than just the standard earnings per share and revenue, so let's dive in. The earnings per share, it was a beat, 153 versus 150 in terms of the estimation from the market. Revenue 90.75 billion. We have here analysts targeted around 90, so it was a double beat on the face of it. Now, in terms of revenue, we do know iPhone essentially 46 billion or just under. Market was anticipating around 46, so very marginal miss. Mac revenue came in a lot stronger, 7.5 versus 6.86. We know the iPad revenue coming in lower at 5.6, and the other products revenue as well pretty low. They did, however, beat on the services, 23.9 versus 23.27. Now, gross margin 46.6, so pretty much coming in line with what the market expected. And typically moving forwards, their forward guidance, it isn't something that Apple do typically give to the market, but the expectation is there that around the low single digits moving forwards for the next quarter in June. Now, we are going to take a look at essentially this information here and take a deeper dive so we can also look on a geographical basis. But the one thing that I want to point out that maybe it may have passed you is they don't do a breakdown in terms of the Vision Pro. So we don't really know whether or not the Vision Pro was a very strong contender for why their growth, or in fact the lack of growth, I should say, in terms of this quarter. So just something to bear in mind. They haven't split that out. It does look, in my opinion, that if they haven't released this information, it hasn't performed as well as maybe they would have liked. And if you just look at the sentiment around in terms of Vision Pros, there aren't many people that do talk about it with high regard. In terms of the company's numbers, so their total revenue, as always, we do want to see a minimum of 3 to 7% year on year. What we do know, over the longer term, they have increased their top line by double digits, as we can see, in fact, 100 or in fact more than 100% growth, so they have more than doubled their top line. And when we look at it on a graphical format, we can see the trend does look very good over the longer term. However, we can note their top line did decrease from 2022 to 2023, something we do want to keep our eyes on to ensure that they don't have another year of decreasing revenue. We can see it go from 394 billion to 383. How does the bottom line look? Did it also double? Well, we can see very strong performance, just under 40 billion in 2014 to around 97 billion in September 2023. So yes, very strong, more than doubled in fact, and again, it is moving in the right direction, although we can see over the last year a decrease pretty much following that top line approach as well. So yes, over the longer term, we do see some strength in those numbers, but what we want to see as investors, we want to see that growth continue into the next few years. But the last few years, as we can see, both on the top line and the bottom line have been fairly poor. Now, when we take a look at the health of the company, their total cash versus their total debt, we know they have around 25 billion in cash and short-term investments in 2014. Latest quarterly period, we note 73 billion. So they do hold a lot of cash. It has increased over the longer term, but we also note some inconsistency. Some years a lot larger than others. Not a real red flag indicator. In fact, no worries at all, but always good to analyze and compare to the total debt as well, numerically and directionally. And we can see that total debt has increased from 35 billion to 108 billion. And we actually notice now, for this point of view, in terms of our review, they actually have more debt than they do total cash, which is interesting. With these typical Mag 7 companies, we actually see the opposite. So just something for your own consideration. We then take a look at their earnings, how it's performed over the last few years. And interestingly, over the last 4 quarters, they have in fact beaten every single quarter. So there's a positive sign, good track record. And the expectation, though, is that it is expected to drop the earnings per share into FQ3. But you could argue that is just seasonality. But it is expected to increase and then another decrease into FQ2. But we also noticed that in 2024. So we do see that as just seasonality, as we mentioned. But overall, year on year, it is expected to increase. But notice it is only by single digits, something that maybe you would expect, something maybe not. Again, just there for your own investment thesis. So now let's take a look at the valuation grade, and they do get an F grade. Few reasons for this. Well, when you compare it in terms of others in the market, the sector median, on a non-GAAP basis, forward-looking 26.4, sector median lower at 23. When we look at it on a PE gap, again, very similar, 26.47, although we do note the sector median is higher at 28. And in terms of the other metrics, the other ways to analyze companies, for example, the price to sales or the price to book, we do note they are trading much higher than the sector median, 2.7 versus 6.91, 3.79 versus 37.07. Again, depends on how you do look at stocks, whether this is part of the valuation or not, but we do see they do get an F grade. When we take a look at their growth grade, and this is one of the reasons why I do see trouble ahead for Apple, it is the growth moving forwards. Year-on-year growth, negative 0.47%, sector median 3.5%, revenue on a forward basis, low single digit, sector median at just under 7%. And again, we can see that trend continue on the other metrics. And in fact, as we do like to point out, in terms of the earnings per share, long-term growth rate over the next 5 years, they expect year-on-year increase of around 10%, whereas the sector median is expecting around 13.89. And in fact, when we did take a look at the essential earnings, they were only expected to increase year on year by single digits. So this is over the next 3 to 5 years. So again, lots to consider with this company. A lot of people will still be very bullish, and that is completely fine as long as your investment thesis backs it up and you are satisfied. Profitability grade, well, they get an A+, the best score obtainable, so 45% in terms of the trailing 12-month gross profit margin, lower than the sector median of 48.55%. Bottom line net income margin, 26.16%. As we can see, the sector median coming in a lot lower at 2.41. So their bottom line does look very strong, does look very healthy. They just need to understand the market and how they can continue to increase their top line, as that iPhone sales is a massive hit. When we do take a look, however, at their cash from operations, absolutely incredible. We will also take a look. They are a free cash flow machine, 116 billion versus 88 billion from the sector medium. So lots to consider. And when we take a very quick look, now these are just comparable companies in the technology hardware sector. We have Dell, Supermicro Computers, and others. Over the last year, not a great year for Apple. Even after reinvesting those dividends, you still would at least be up 10.23%, one of the worst performers in comparison to others. When we extend it over the last 5 years, not too bad, 267%, in fact, very strong. We do, however, note Dell slightly higher. And over the last 10 years, we can see Apple, in fact, the second best. The only thing, always remember when you are looking and doing your estimations, your projections, yes, it's good to look at past data, but past performance is not an indicator of what will happen in the future, so bear that in mind. This is just to show you how they've performed over the longer term. Now, before we do look at the metrics, the dividend safety and so on, let's look at insider ownership. Now, 0.06%. We noticed 7 instances of insider selling over the last 12 months, 169 million worth in fact, and we can see over the last 4 quarters some sense there of insider selling, 46 million just in quarter 2. Now when we take a look to see who these insiders were, in a more recent time we have here the 11th of April, the COO as well as the CFO selling around 50,000 shares or slightly higher. Average price, in fact, lower than the current trading price. In total, we do see around $20 million. And this is why I say we can see they have sold it lower, that essentially insider selling isn't a bearish signal. They will sell for many reasons that could be personal or financial. But again, the information is there if you do want to take it as a bearish signal and factor it in, whether it's your margin of safety or any other element within your own analysis. We then take a look at institutional ownership, so 60%, 29 billion worth of sales by institutions, but 94 billion, so a significant amount more buying than selling, and we can see the largest buys coming in quarter 4 of 2023, and we also note not just over the last 12 months, but also in the more recent quarter, Q1 24, more buying by institutions than selling. Now also just a quick reminder to let you know we have released our latest free weekly article. If you want to gain access, do click on the pinned comment below. You can read straight away for free. We also want to draw your attention to how to find undervalued stocks. This is one where we go through every single website that we use on the channel. A lot of people do request that, so we have put that all in a very brief article so you can digest. Now let's take a look at what they've released. Now this is very important because it does show us in detail their sales, the breakdowns by category, and also by geographical location. The first thing to note here is that their total sales, whilst it did beat analyst targets, yes, very positive, but from the same quarter in 2023, they are down, going from 94.8 billion to 90.8 billion. So that is something that I just want to bring to your attention. In fact, their top line has decreased from the same quarter over the same period. So not great at all, not off to a good start. Again, yes, the share buybacks was very good for investors, but these are things you need to think about in terms of the longevity of the company and the fact that they need to continue to increase their top line. So let's go through the first segment, net sales by their reportable segment. So when we compare it, we do in fact note in terms of the Americas, their top line here is down, although marginally. Europe, it is up marginally. We do see Greater China down quite significantly, around 1.5 billion. Japan also down by around 1 billion, and the rest of Asia Pacific around 1.5 billion. So we can notice pretty much every single reportable segment is down other than Europe, which is up marginally. So again, these are all just things that I want to bring to your attention because I do believe it is very important. Then for those who like to see it by category, always good to understand where the growth is and where essentially the negative growth is. So we see a massive reduction in the iPhone sales, going from 51.3 billion from the same quarter in 23 to 46 billion. So we are talking around a 5 billion, so just over a 10% drop in the iPhone sales. In terms of Mac, we do have a marginal increase, 7.1 billion to 7.4. The iPad, we can see over a 1 billion drop for the quarter. Wearables, so like the iWatch, home and accessories and other items, also down. And we see these services, which has really helped propel this top line. It is up by around 3 billion. And therefore, if this wasn't the case, this number would have looked even worse. So again, just something that I do really want you to understand. Yes, share buybacks are good for essentially investors. We always talk about it. Share buybacks, good, returning excess cash to investors. you get more ownership over the essential company, but also understand the underlying fundamental metrics of these companies, if they're getting better or if they're getting worse. And also what I just want to draw to your attention, they haven't split the Vision Pro, so we don't really know how well that is. And let's be honest, if it was very strong, they would have included it or at least mentioned it. So let's look at the metrics now. Dividend safety score 99, very safe, the highest score obtainable. Market cap 2.7 trillion. And also we haven't actually mentioned it so far, but they did have a dividend increase as well. Now in terms of the key metrics from the last recession, plus 14%, well above the average of the S&P, which was negative 12, and a marginal return or a marginal beat from the S&P, negative 50, with the S&P negative 55. As we discussed, a dividend increase, yes, 4.2%, no, not great, 4.2%. Typically, we want a minimum of 4% just to keep up in line with inflation. For a company like Apple with a low payout ratio as well, we want to see a lot better just over the last 5 years as well as over the last 10 years. What we have seen is high single digit, and what we can see not just this year or in fact yesterday's announcement, but also over the last year, 4%, very poor in my opinion if you are an investor. We do know, though, they have been increasing those dividends for the last 11 years. Now, in terms of dividend yield theory, for those who are new, it does state a company is undervalued when the current yield sits above the 5-year average. That isn't the case here, although it's not too far off, so we could argue reasonable valuation. The same can be said here around the forward P as well, 27.2, not far off the 26.3 rolling average. And we do note it is slightly higher than the sector P of information technology at 25.1. Now, we know the free cash flow, it is essentially a metric that we like to see for the safety, and we want to see below 60% as a blanket rule. That does give us faith that management are able to essentially offer double-digit dividend increases. Earnings always available if you want to look, but we do believe it is susceptible to manipulation by management through accounting. Now look, the payout ratio has been decreasing. That is typically a good sign if they also increase, but we note they're not increasing that dividend by that much. 4%, it is just keeping up in line with inflation. So in terms of a real growth, it is nil. And we do note 15% in 2023, the same expected in 2024. It's just a shame that we didn't also see a nice increase. But again, share buybacks are also very positive for the shareholder as you don't get taxed. In terms of free cash flow, always mention that we want free cash flow growth year on year. That is something we keep repeating, and we do see that pretty much consistently for this company over the longer term. In fact, it has increased more than 3 times, expected to increase in the full year of 2024, so that is a positive sign. Growth, now this is one of the areas that I do talk about as a bit of a disappointment. Yes, some years they've had strong double-digit growth, 2015 and 2021 notably, but 2023, negative 3%, very poor. It will be interesting to see the full year for 2024. I do also believe for 2024, we will see again negative growth. So numerically, just another format on the right. So shares outstanding, this is one thing that they do very well, and they will continue after the news yesterday, returning that excess cash. They've done a lot of share buybacks over the last 10 years. In fact, buying back nearly 10 billion worth of shares, and they will continue to do so over the next few quarters, and we can see they probably will continue to do that every single year, as that is something they consistently do. So a very big positive. ROIC, now always very strong to see this for this metric with this company. Double digits is what we want to see, minimum 10%, just to give us faith that management are able to effectively allocate their capital. And we can see over the longer term, that is what they've done. Last 3 years, very strong as well, 65%, 61%. So this makes it very attractive to potential investors. Margins looking very healthy, above 12% pretty consistently and very strong. Last 3 years at 30%. And as I mentioned before, they are a free cash flow machine. Very strong numbers here on the margins, 26% in the more recent year. So lots to like about this company. Net debt to EBITDA, then the earnings before the interest, tax, depreciation, amortization. It does give us essentially an indicator of the number of years it would take the company to pay off all of their debt net of cash on hand. And it also correlates to balance sheet strength as well as dividend safety. Below 3, and that is what it's been for the longer term. In fact, below 1, 0.44 in 2023, expected 0.23 in 2024. So this is a very strong company in relation to their balance sheet strength. So nothing to worry about if there was any worries at all. So let's jump into the valuation model. As always, if you enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, the first model we're looking at is the multiples valuation model. Companies in a similar sector and size. We have the P multiples, the average, multiplied by the EPS of Apple to get an intrinsic value. Now, this shows undervaluation, but it is around $1 away, so we would consider this reasonable valuation. But as always, bear in mind, we don't look at any of these models in isolation. We then have the discounted cash flow model with the free cash flows year on year. Average growth rate 9.89%. So we've gone pretty much in line with that at 10%. With the discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, gets the equity value, divide by shares outstanding, and we get an intrinsic value showing undervaluation. Now, we have used this 10%, but again, a lot of people will say that is the lower end. So we have used that, and that is what we also can see maybe as a lower end, giving an implied upside of 12%. We then move on to a medium rate of 12%, and if you were believing that that is what you should use, then it would give an intrinsic value of $237. If you believe even that's too low and it should be 14% moving forwards, it would give a price of around $273 with upside of 49%. Now, you may believe none of these numbers are correct. You may want to try different numbers. As always, you can grab a copy of this valuation model by clicking on the pinned comment below. You can run your own numbers through. You can look at your own company or other companies on your watch list as well. So we're going to take through the 10%, so the lower growth rate target, through to the final slide. And the intrinsic value in today's episode is purely the average of these two models, coming to $195. Now, with the current price of $184, we do always start off with a margin of safety of 10%, which we execute on if it meets the three golden criteria: the wide moat, the strong financial metrics, and the good forward-looking data. If you believe that, then it does look to be a buy around $176. So after the pop now, it doesn't look like it does have a 10% MOS level. So in terms of a 5%, we pretty much see right now it is trading at that 5%, but a lot of people will argue a company like Apple, it does and should trade at a premium, so therefore are satisfied with the 5%. For those that want to see 15%, it is a buy up to 166, and at 20% around 156. But unfortunately, right now, we only see with our estimates and judgments a 5% MOS level. Now, in terms of Wall Street and their forecast, well, over the next 12 months, they see upside around 10%, a price target of $203. But what we want to hear are your thoughts, whether or not you believe this was a good earnings report. Maybe it is one that now it is on your watch list, or you're looking to sell, or even maybe just buying and dollar cost averaging every day. Let us know your thoughts. Now, me personally, as I don't see a lot of value in this company right now, this is one that I do hold and will continue to hold indirectly via ETFs. But as always, let us know your thoughts. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.